Welcome to the March 2nd, 2020 Advance Report from McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, President, McGowanGroup, and your financial weatherman with your fast-paced tour of the global financial markets. And this kind of market is exactly why we have the devotion to do this YouTube channel for our clients first, and yes, NetWorthRadio.com listeners and subscribers. This is why you subscribe, because we're going to take you deep into the updates here for March 2nd, the week of March 2nd ahead. By the way, it is Texas Independence Day, and we'll get to how Texas may be your solution to a great recovery for the equity portion of your portfolio. That's coming up. We've also got two solutions at the end that I'll highlight, and I want to show you a fast-paced tour of what's happened in the coronavirus panic of 2020. And it is a panic. This has been the fastest 15% decline in U.S. equity prices really since the crisis. And in modern history, it may be one of the most quick and severe corrections that we've ever seen. The global markets have poised themselves for the coronavirus, and you can see that preparation beginning. Here's a high on the Dow that we covered right at Valentine's Day. 29,568 was the high in the Dow. This week, the Dow falling below 25,000. Wow, that was a quick, almost 15% decline in the Dow. What gives? Well, certainly it's the coronavirus. I want to show you the other market impacts very quickly on what the institutions are doing. Clearly, they're selling. Two important updates: Apple, Microsoft, MasterCard, all saying this disrupts any forecast that you had for our companies. We told you the tech companies were priced for perfection, and this is not perfection, with a huge part of Chinese production actually offline. And how long does that take? I've got research for you here that you just can't get anywhere else. So be sure to subscribe and forward it to your friends that are worried about the financial impact of the coronavirus. This is a key update from McGowanGroup Research, and I believe it is unique, and it forecasts what will be the end of the financial market crisis. Now you're looking at Treasury interest rates. When they buy Treasuries with both hands, yes, it's because of fear. It's a hedge, if you will. It's a move to fixed income. But there is a mistake built into these allocations, in my opinion. If you take a 30-year U.S. Treasury, notice the yield went from 2.4 now down to below 1.7, the lowest in economic history. And the same with the 10-year U.S. Treasury. Notice it inverted and fell below the green T-bill. The green T-bill going to 1.25. The 10-year Treasury going to 1.2. What gives there? Well, they're forecasting, well, actually, the Fed is leaky, just like the rest of Washington. It is clear the Fed is poised to cut interest rates by 0.25%. That's not only the expectation, but there had to be some leaky inside information from the Fed that got out to the banking system, who they usually play golf with. But it means a Fed cut in response to stave off the financial panic. When they announce it, well, we don't know if they'll wait till the next meeting or not. But the 10-year Treasury below that, an inversion, saying things that are addressing, the Treasury market's addressing a global slowdown. Yes, oil smashed down to below $45 a barrel at the lows this week, actually closer to 44. So West Texas Intermediate crude could be one indicator of where we want to go with this, but let's address a more conservative approach first. The COVID-19 malfunction, if you will, of the flu virus, a nefarious permutation, but it is a cousin to the flu. What does it look like? This is the globally confirmed cases, just below 84,000. Two parts to this graph. Don't miss this. This is a parabolic increase, y equals x squared for those that went to math school. Well, What does that mean? It means every day we got more cases than the day before. What does this mean? A decreasing number. It's not going up as fast. And this asymptotic movement here says it may not even reach 100,000 cases before a key date, which I'm about to cover. Now, let's look at the other part. Confirmed deaths. A tragedy here approaching 3,000 at 2869. How long does it take this graph to reach 3,000? Well, at this rate, a lot longer than it would have at this parabolic rate. Notice the shift, acceleration to deceleration. That's your key message from this report. How do we apply it? What's the next significant date? When we apply this, what we're going to see is, wow, this looks predictable. This is every year, all the way back to 2009. So you've got a significant amount of data here. This is the influenza admissions to emergency care facilities. And when does it peak? Well, there's October, there's February, there's New Year's Eve, wow, February 7th was the peak in flu season. Well, COVID-19 is a malfunction of the flu. Well, notice when it peaks, it doesn't go back up. Here you peaked, went down a little bit, peaked again. But once you have a significant peak, that's the end of flu season. And this graph says, looks like it was February 7th, about when it does every year. March 19th, of course, is the beginning of spring. The first time that you see the number of active cases begin to fall, I believe the market panic is over and you want to be well positioned. Now, for the items that you have that have a good yield, you're probably in the right position because you get paid to wait. And you can reinvest. Recommendation 1, reinvest any of your high dividend situations because you're buying your way out of the crisis faster. And that's exactly what worked for us in 2002 and 2008 to recover from an unexpected crisis in less than 12 months. And we used a couple of asset classes I'm about to cover. Well, one of the asset classes, energy infrastructure, that we've been accumulating is actually shown here as the S&P 500 energy sector. Energy infrastructure is the more reliable dividend component of what you see here in the white graph. Well, the yellow graph is the NASDAQ. That's 1999. We said that tech stocks were partying like it's 1999. And certainly the infatuation with technology justified by a lot of the growth rates, those growth rates just got snapped. Same thing that happened to the NASDAQ in the tech wreck. NASDAQ goes 80% down and 5 years later is still less than half price. Energy infrastructure. Energy had already been through a bear market cycle, and the S&P 500 energy sector has been pounded recently. This graph is 99 through 2005, the beginning of 2005. Energy doubled over the same time period that technology was absolutely wrecked. And that sector could be one of the keys because it has one of the highest dividend rates in the world for reliable forward dividends, according to our research. Obviously not without price risk, and even energy infrastructure was down 15 or 20% when the tech wreck finally unfolded at the bottom. But the risk was less and the net gain was more. Oil's only $45 a barrel at this point, and in the second quarter, you begin to resume production. Things get back to normal if the normal flu sequence happens to apply to COVID-19. And our graphs tell us this thing leveled off and the financial markets may in fact have overreacted. Where have they overreacted? I believe global high yield. So I ran this. This is a representative of the global high yield market. Those are bonds and loans in a big basket. And what doesn't change usually is your interest payments that you get from those loans. If the issuer can pay, you get the interest. What was the net effect? If you bought it before the crisis in '07 and you held it through 2012, that meant you went 8, 9, 10, 11, 12. 1, 2, 3, 4, 5 years. What was your total return? In this example, if you reinvested your dividends, it's a 16% return. That's strong. By this time, the return was somewhere around 15% at these high points, even including the Great Crisis, because you gained advantage with real interest being earned and you own a basket of loans and bonds. Global high yield was our biggest position before this. It did go down in price during this recent decline to some very attractive levels that we estimate at about 80% of the par value that those loans and bonds control. That's enough to have gain potential and coverage for any potential defaults. I'm Spencer McGowan, President, McGowanGroup. It's time for an update to your plan. We're determined to make sure our clients go forward with record income and gain potential, and I just covered the design for how we recovered from 2002, 2008 to record profits in less than 12 months. Go to NetWorthRadio.com, fill out the preliminary client questionnaire, subscribe, and share this with your friends that are spun up about the 2020 coronavirus panic. Thank you. We'll be back next week with clear updates on COVID-19 and the 2020 crisis. Thank you for tuning in to our YouTube channel. I'm Spencer McGowan, President, McGowanGroup, your financial weatherman. We sponsor each week NetWorthRadio.com broadcast that has the charts and graphs, many of which you saw today. We also sponsor this YouTube channel. Be sure to subscribe for fast breaking news, an alert when we post something in a market condition that may have changed. Our goal is to help you as an investor make the right decisions at the right time. And that's part of what this YouTube channel is about, as well as NetWorthRadio.com. I am well served with a team of 10 people, including myself. And that team that cares is actually made up of people who devoted to your net profits and your success, as well as excellence in service. If you want an educational experience to follow this up, get to NetWorthRadio.com, the McGowanGroup.com. Right here, we disclose our net client experience all the way back to 2001. What that includes, the bear market cycles of '02, '08, 2018, and the recoveries through the most recent quarter. That is true education of investors and exactly how our clients have done, disclosed right here. Further disclosures, value at risk of loss. Yes, investments are going to fluctuate. That's part of the reason for this broadcast. And that can actually work to your advantage. We'll build that into your plan. So I urge you to go to NetWorthRadio.com, fill out the preliminary client questionnaire, a free 1-hour brainstorming session by phone or at the Crescent in Dallas, and we will map out a multi-year plan for you and your family that's appropriate. Just because we talk about a security on this broadcast or any securities doesn't make it a recommendation for your portfolio until you have that written plan. Thank you for tuning in today, and we'll be back next week as your financial weatherman.